Hello and welcome. I'm Jeff Snyder, Executive Vice President at Gateway, and I'm here to present another Gateway video. Today's concept will focus on determining a life insurance need, and the concept is to keep things very basic and very simple, as most insurance agents tend to overcomplicate things. When it comes to determining an insurance program, there are really only 3 or 4 things to consider when it comes to implementing your insurance, and that would be the amount of coverage, the type of coverage, what carrier or company that you'd place that insurance coverage with, and then finally, depending on your situation, whether or not that insurance program should in fact be owned inside or outside of a trust. When it comes to determining the insurance need, there are basically only 2 fundamental approaches to doing so. The first is human life value or human economic value, and it's a simple math formula. You simply take your current income multiplied by the number of years you plan to work until retirement to come up with a number. So for example, if you were making $100,000 a year and planned on working over the course of the next 30 years, you would generate $3 million. That's $3 million to provide for you and your family over the course of your working life. So if your goal was in fact to replace some or all of that, you would consider implementing an insurance program for $3 million. The second approach to determining an insurance need is a basic needs analysis approach, where you add up the total of all your basic immediate needs and add that to the amount of capital necessary to provide an income for ongoing needs. So for example, if you had a $400,000 mortgage and $150,000 to take care of college funding and a $50,000 contingency fund, your immediate needs would total $600,000. In addition, assuming you wanted to provide $6,000 a month or $72,000 a year in after-tax income to provide for your surviving family, assuming you were to earn a 5% gross rate of return and net 3% after taxes, you would need an additional $2.4 million worth of capital to generate that $72,000 a year. So if you took the immediate need of $600,000 and added it to the 2.4 of capital to spin off the income, you would, just like the first example, need $3 million worth of insurance. That being said, of course, you would then consider whatever available assets and existing insurance exist, add those numbers together, and subtract that from either approach that you use to determine the insurance need. So for example, if you had $1.5 million of existing available capital, including insurance, and you offset it against that from the $3 million of capital to provide for your family, worst case scenario, you'd have a $1.5 million shortage. So like I said, keep it simple, don't overcomplicate things, and focus on determining a need. That's the idea for the day. Thanks.